why this ETF appears in most long-term portfolios, and when it stops working in 2026. You'll want to grab a pen for this one, because I'm about to walk you through the kind of portfolio analysis that typically happens behind closed doors in wealth management offices. A quick note before we continue: ads may play during this video. Your support keeps this content free. Now let's jump in. This is the strategic framework that explains why certain investments dominate institutional portfolios, and more importantly, how to recognize when that dominance is reaching its limits. There is one specific type of fund that shows up in portfolios across virtually every major advisory firm in the country. It isn't there because of marketing or simple performance chasing. It's there because it solves a very specific structural problem that every long-term investor faces. If you understand why it works, you'll also understand the conditions under which it stops working. That understanding is worth more than any hot stock tip you'll ever receive. The fund I'm talking about is a broad market index ETF. Before you think this is a generic endorsement, let me be clear. We are going to examine the mechanics of why this position dominates, the specific economic conditions that make it effective, and the warning signs that those conditions are shifting. Because 2026 represents a potential inflection point that most retail investors aren't paying attention to, but institutional money managers absolutely are. Let's start with first principles. When you own a broad market index ETF, you're making a very specific bet on three things. First, you are betting on corporate profit growth. You're betting that businesses will grow faster than inflation. Second, you are betting on the efficiency of capitalism. You're betting that the ability of businesses to generate returns on their money remains functional. Third, you are betting on the stability of value. You're betting that the math used to value future earnings, what professionals call the discount rate, doesn't spike so dramatically that it destroys the value of today's profits. For the past 15 years, these assumptions have held spectacularly well. Profit margins expanded to record highs. Interest rates remained historically low, making future earnings more valuable in today's dollars. Huge share buyback programs reduced the number of shares available, boosting the value of the remaining ones. Technology drove massive productivity gains, allowing companies to grow without hiring a massive amount of expensive labor. It was a nearly perfect environment for passive, set-it-and-forget-it investing. But environments change. The advisors who get paid to protect significant wealth aren't just watching a green or red line on a screen. They're watching the structural factors that drive that line. They are monitoring profit margins for signs of margin compression, which is where costs rise faster than prices. They are tracking how fast interest rates change. They are assessing whether the power is shifting back to workers in a way that hurts corporate bottom lines. Much of the S&P 500's returns over the last decade didn't just come from companies making more money. It came from multiple expansion. In plain English, this means investors became willing to pay higher and higher prices for every dollar a company earned. Think of it like a house. If a house earns $10,000 a year in rent, and people used to pay $100,000 for it, but now they are willing to pay $250,000 for that same $10,000 in rent, the multiple has expanded. That's great for the person who bought early, but it's risky for the person buying today. The price-to-earnings ratio of the market has moved from the low teens to the mid-20s. This isn't a problem if earnings keep growing. But if earnings growth slows while the price stays high, you're looking at a recipe for disappointing returns. If that price-to-earnings ratio contracts, meaning people decide they aren't willing to pay that premium anymore, at the same time earnings slow down, you have a setup for painful losses. This is where 2026 comes into focus. We are seeing several structural headwinds converge all at once. The massive government spending from the pandemic era has finally faded. The Federal Reserve has signaled that rates will likely stay higher for longer, which creates a gravity that pulls down the valuations of stocks. We are also seeing margin normalization. Those record-high profit margins are finally starting to shrink as the cost of doing business, from electricity to shipping, stays high. Finally, the world is becoming more fragmented. Supply chains that were once cheap and efficient are now expensive and complicated. None of these factors alone is a disaster, but together, they represent a meaningful shift in the weather of the market. I'm not predicting a crash, and I'm not saying you should hide your money under a mattress. I am saying that the conditions that made passive index investing a no-brainer are evolving. When the broad market stops benefiting from rising valuations, three things change for your portfolio. First, returns become dependent on actual business success. You can no longer rely on the tide lifting all boats. You have to care if the companies in that ETF are actually selling more products and cutting real costs, or if they are just using accounting tricks and financial engineering to look successful. Second, the gap between winners and losers widens. This is what we call dispersion. When everything goes up together, it doesn't matter what you own. When things get tough, the difference between a high-quality company and a struggling one becomes massive. In a passive index fund, you own both in equal measure based on their size. You are forced to buy more of the companies that might be overvalued just because they are large. Third, the math for alternatives changes. When you could get 10% returns from an index fund and bank accounts paid 0%, bonds were boring. But if index returns drop to 5 or 6%, while you can get 5% from high-quality bonds with almost zero risk, the choice becomes much harder. Index funds are no longer the only game in town. So, how do you handle this? You need to move from owning more stocks to owning different types of risks. This involves liquidity management and strategic capital allocation. In a world of slower growth and higher rates, assets that generate current income become the stars of the show. If we are entering a period where profit margins are squeezed, companies with pricing power, the ability to raise prices without losing customers, become more valuable than growth companies that don't make a profit yet. This is also the time to look at geographic diversification. For 10 years, the U.S. market has outperformed the rest of the world. This has led to a massive valuation gap. U.S. stocks are expensive, while international stocks are relatively cheap. This doesn't mean international stocks will definitely win, but they have a much higher margin of safety. If things go wrong, the fall might not be as far. There is a structural reality of index funds that most people miss. Index funds are market cap weighted, meaning they automatically buy more of whatever has already gone up in price. In a trending market, where stocks keep going up, this is brilliant. It's like a sail that catches every gust of wind. But in a mean reverting market, where things that are too expensive eventually fall back to earth, this is a trap. You end up with your biggest bets on the most expensive, overextended stocks at precisely the moment they are most likely to drop. Professional wealth management isn't about finding one perfect fund. It's about building a system that works in multiple scenarios. The broad market ETF remains a core holding, but it shouldn't be your only holding. In 2026, sophisticated investors are stress testing their portfolios. They are asking what happens if the Fed keeps rates at 5% for another 2 years. They are asking what happens if profit margins drop by 2% across the board. They are looking at asset-based lending, dividend-paying stocks, and real estate investment trusts. These weren't sexy when tech stocks were going up 30% a year, but they look very attractive when you need to generate a steady 5% return in a volatile market. I want to be clear that this isn't market timing. Timing is trying to guess the exact day the market hits a peak. That's a fool's errand. Cycle awareness is different. It's recognizing that the investment weather has changed from a sunny summer to a chilly autumn. You don't sell your house because it's autumn, but you do put on a coat and check your heater. You are adjusting the dials of your portfolio, perhaps moving from 80% stocks to 60%, or moving some of your growth money into value or income positions. Professionals make incremental changes based on probabilities. If the chance of a low-return decade has gone up, they don't quit. They just stay thoughtful. They reduce exposure to the most expensive areas and increase exposure to the areas that have been ignored. To wrap this up, let's look at the core reality. Broad market ETFs have been powered by a perfect storm of low rates and high margins that is now ending. Most investors are overexposed to the most expensive U.S. stocks because of how index funds are built. The solution is to build a complete portfolio that includes international stocks, fixed income, and real assets that protect against inflation. The goal is to shift from performance chasing to cycle awareness. The financial industry has done a great job convincing people that passive investing is foolproof. It is simple, yes, but simple works best when you have a tailwind. When you face a headwind, you need a more robust strategy. This analysis is designed to help you rethink how your money is positioned for the next few years. Before ending this video, I want to emphasize that portfolios built for 2010 to 2023 need to be reassessed for 2026 and beyond. Not because they're wrong, but because the environment is different. If you are heavily concentrated in U.S. large-cap growth, because that's what worked for the past decade, ask yourself if that's a deliberate choice or if it's just inertia. If you're underweight fixed income because rates were zero and bonds seemed pointless, ask yourself if that logic still holds when rates are 5%. Simple works great when the tailwinds are strong. It works less great when conditions are neutral or headwinds emerge. That doesn't make it wrong. It makes it incomplete. The complete picture includes understanding when your strategy is well suited to the environment and when it needs adjustment. If this analysis shifted how you think about portfolio construction, subscribe for more institutional-grade insights. Like this video if it gave you clarity on navigating the current market environment, and drop a comment with your thoughts or questions about portfolio positioning for the years ahead. Your engagement tells me what content serves you best. This content is for educational purposes only and does not constitute financial, tax, or investment advice. Consult with a qualified professional before making any financial decisions.